Canada's financial markets are quietly becoming a hotspot for global borrowing, and it's all thanks to something called maple bonds. In 2025, we're seeing an increasing number of international companies from Europe, Asia, and beyond choosing to issue bonds in Canadian dollars rather than US dollars. Why is this happening? What makes Canada's bond market so attractive right now? And what does it mean for investors, for the Canadian dollar, and for the economy overall? Let's break down the rise of maple bonds and why they matter more than most people think. Section 1. What are maple bonds? 045 2 Art. Maple bonds are bonds issued in Canada in Canadian dollars by foreign companies. Think of them as a way for global firms to raise money from Canadian investors without converting to another currency later. For example, a European energy company or an Asian bank might issue a maple bond to attract Canadian pension funds, insurers, or asset managers who prefer CAD-denominated investments. Why the name maple? Just like samurai bonds in Japan or Yankee bonds in the US, maple bonds get their name from the national symbol, Canada's maple leaf. Several global and local factors are fueling this trend. 1. Lower interest rates in Canada. The Bank of Canada recently began cutting interest rates after years of tight policy, while some other economies are still holding rates higher. This makes borrowing in Canadian dollars slightly cheaper for foreign issuers. 2. Investor appetite for non-US assets. Many Canadian and global investors are diversifying away from US bonds. The Canadian market offers stable yields and less exposure to US market volatility. 3. Strong institutional demand. Large pension funds and insurance companies in Canada often prefer CAD-denominated debt for balance sheet reasons. Maple bonds fit that demand perfectly. They offer new supply without currency risk. 4. Currency diversification for issuers. Borrowing in Canadian dollars helps international firms diversify funding sources and hedge against USD or EUR exposure. In 2025, we're seeing a mix of issuers, including European financial institutions, raising capital in Canada to tap its deep bond market, Asian corporates using maple bonds to access cheaper funding and diversify currency exposure, global infrastructure and energy firms financing projects with long-term Canadian investors. For Canadian investors, these issuances bring more variety and international exposure to local fixed income markets. Visual suggestion: show world map with arrows pointing into Canada, Europe, Asia, US. Benefits for foreign issuers: access to stable demand, lower costs, and a strong investor base. For Canadian investors, more options to diversify portfolios without taking on foreign currency risk. For Canada's economy, inflows of foreign capital strengthen market depth and position Canada as a trusted financial hub. Challenges: currency and interest rate risk. If exchange rates shift or if the Bank of Canada's policy changes unexpectedly, returns can vary. Market size limits. Canada's bond market is smaller than the US, so very large issuances can be less liquid. Global uncertainty. If global borrowing costs rise again, foreign issuers may shift away from Canada temporarily. The rise of maple bonds signals growing global confidence in Canada's markets. It reflects the country's strong banking system, transparent regulations, and stable currency. Over time, it could make Canada a go-to destination for international funding, not just for bonds, but for other financial products too. For retail investors, it could mean more access to international issuers through ETFs or mutual funds that include maple bonds. Maple bonds may not make daily headlines, but they're becoming a powerful symbol of how interconnected global finance really is. Foreign firms see opportunity in Canada's stability, while Canadian investors benefit from a broader, more diverse bond market. It's a win-win dynamic, one that's helping Canada quietly strengthen its role in global finance. This video is for educational purposes only and should not be taken as financial or investment advice. If you'd like more deep dives into global finance, fintech, and economic trends, hit the subscribe button and stay tuned for more.